Good day and welcome to the Scope Ratings webinar. My name is Matthew Curtin. I'm Deputy Head of Communications at Scope, and it's my pleasure today to have with me Eiko Siebert and Thomas Gillet, who are respectively Executive Director in our Sovereign and Public Sector Ratings team. Eiko is our lead analyst on the United States, and Thomas takes the lead on France. And it's on the public finances of these two countries that we are going to have a discussion today. These are clearly turbulent times, both for the United States and for France, and interesting ones for credit rating agencies. Our goal today is to give you some short but in-depth insight into our outlook for the two sovereigns from three perspectives. The fiscal strains that they face, the funding flexibility that they have, and the governance issues that have become important risk factors for both countries. As usual, if you've got any questions, please put them in the chat window and we'll take them after our initial discussion. And we'll send the slides to all those who have registered after the webinar is finished. So without further ado, I'm going to hand over to Eiko, who's going to set the scene in the context of our recent rating actions for the US and France. Eiko, over to you.
Thanks, Matthew. Good afternoon. So before we dive into the details, I wanted to just briefly outline the recent rating actions we took on the sovereign ratings for the US and France. We downgraded the US's sovereign rating from AA to AA- about 1.5 weeks ago. The key drivers for this downgrade were, first of all, the deteriorating public finances, and then second, the weakening governance standards. This increases the gap between our rating and the average rating of the large US credit rating agencies. Although, as you can see, we have had a lower rating for the US for many years, which partially reflects our view on the US's fiscal framework and also the repeating debt ceiling standoffs that we see. For France, there has been some convergence of the average rating by the US agencies towards our rating level. We downgraded France's rating to AA- in October 2024 and changed the outlook to negative in September 2025. The key drivers for this latest rating decision were, first of all, the weakening fiscal outlook and the challenging political outlook. So clearly, both countries face similar challenges from a sovereign rating perspective. And in the next half hour or so, we wanted to just discuss these in a bit more detail. I'll start with the fiscal outlook for the US, and my colleague Thomas will then enlighten us a bit on some of the dynamics that we see in France. So public finances in the US have continuously deteriorated over the past few years. And as you can see on the first chart here, the large shocks of the 2008 global financial crisis and more recently the pandemic required significant fiscal support. And over the next years, we see continued high spending pressure and primary deficits of around 4% of GDP every year. And these are not expected to recover significantly. Clearly, the very low interest rate environment after the 2008 financial crisis has come to an end some time ago. For the US, the higher expected interest expenses mean that the headline fiscal deficit will average almost 8% of GDP. This is higher than any European sovereign over the next 5 years, with one exception of Ukraine, which is obviously a special case. The interest payment burden plays an important role for the US fiscal outlook, as you can see in the second chart. The share of government revenues spent on servicing the growing public debt increased sharply from around 7% in 2021 to almost 11.5% by 2024. And we expect this to increase further over the next 5 years, and longer-term forecasts published by the Congressional Budget Office in March indicate that more than 20%, so a fifth of government revenues, will need to be allocated to paying interest by the mid-2050s. Then finally, what does this all mean for the debt to GDP ratio? So we expect it to increase somewhat faster than in France, reaching about 140% by 2030. Partially because there is very little restraint from the US fiscal framework, or at least effective restraint. Among advanced economies, this would place the US as the second most highly indebted sovereign after Japan and above the UK, France, and also Italy. You can already see our expectations for France's key fiscal metrics in the orange lines in these charts, but I would hand over to my colleague Thomas to just take us through the details here. Thomas, I think you are still on mute.
Sorry, can you hear me now?
Yes.
Okay, perfect. So no, I was saying thank you, Echo, for that, and I think like in the US there is a lot to say on the French fiscal outlook, but we'll try to keep that brief. So the French government is strongly committed to fiscal consolidation to reduce the budget deficit below 3% of GDP. And as you can see on the first chart, we also anticipate a gradual reduction of the budget deficit, but we are more conservative than official projections, with the budget deficits projected to average 5% of GDP by 2030, which is obviously a challenging fiscal position. So what is the rationale behind that projection? First, the credibility of the fiscal strategy is undermined by an uneven track record of fiscal consolidation, but also more recently by fiscal slippage in 2023 and 24, and by the recent political instability with two prime ministers voted down by the National Assembly. And then there is also limited budget flexibility with high tax to GDP, rigid public spending. And on top of that, there is obviously the presidential election coming up in 2027. So our opinion is that the government is unlikely to be able to advance important elements of its fiscal consolidation agenda in the near term. And there is also high uncertainty on the sustained execution of the fiscal plan after the presidential election. Now, interest payments are projected to rise in terms of GDP, but also in terms of government revenue, as you can see here on the second chart. What is striking here is that the net interest payments are projected to steadily increase above its long-term average, and despite France's large revenue base, around 50% of GDP. And this rising interest burden is due obviously to a very gradual reduction of the budget deficit, but also more challenging funding conditions. That is the main difference with the previous phase of fiscal consolidation after the global financial crisis. And third, debt to GDP is projected to increase from 60% in the early 2000s to above 125% over the forecast horizon. So government debt increased significantly during COVID, and we anticipate a steady rise over the next 5 years, which means that high government debt will remain a very, very important credit challenge for France and one of the key rating drivers over the coming years. So yeah, that's the fiscal outlook for France. But before we move on with fiscal funding flexibility, maybe Matthew, you have already a few questions on the fiscal outlook.
Yes, Thomas, thank you for that. Yes, we go back to the United States, Eiko. One question we've got here is you've outlined a very challenging outlook for the US. What would it take to stabilize debt to GDP, or at least the trajectory for debt to GDP in the US?
Yeah. So I mean, clearly I could draw up quite a lot of different scenarios for this, but I guess ultimately none of these would be easy to achieve. So one such scenario would be if, so three things happened. So first of all, we saw a sustained increase in economic growth at around 3% every year going forward, so for the entire forecast horizon. This would be exceptionally strong growth in historical context and well above our current estimate of a growth potential of around 2%. In principle, there is some upward potential if, for example, all of the AI-driven investment that we're seeing at the moment translates into a significant increase in productivity. Also, the administration's strong focus on deregulation across all sectors could support higher growth. But I always have to caution, rapid deregulation that is implemented without careful consideration can clearly also lead to the buildup of big financial imbalances and ultimately result in a crisis, even if this can take several years to actually materialize. Because so ultimately what we want to see is a sustainable growth at 3% every year. And then in addition to that, we would need to see lower primary deficits. So for example, of around 1 percentage point compared to our current baseline. This may not sound like that much, but would actually amount to around $300 billion a year, at least in 2025. And that's more than, for example, the annual budget of the Department of Agriculture or the Department of Education. And then finally, we'd also have to see higher inflation being around a percentage point above our baseline. So that's around 3.5% a year. And this without leading to higher financing costs on the financial markets. And if all of these three were to happen, the debt to GDP ratio could stabilize at its current level. But in our view, this seems quite unlikely, also because of the lack of bipartisan support for such changes to be consistently implemented. But we'll discuss the politics of this a little bit later, obviously.
Yeah, we'll get to the politics in a short while. I guess, Thomas, what's interesting about France is one of the idiosyncrasies of the French situation is the debate about pension reform. Can you tell us a bit about how that fits into the fiscal outlook?
Yeah, so on the pension reform, I think the temporary suspension is expected to be credit neutral if the cost related to its suspension is fully compensated by other policy measures, which I think, appears to be manageable in the near term. But now if the government and the parliament get rid of the pension reform, that would be credit negative, as this would add pressure on the long-term aging costs, even if France's demographic outlook is relatively more favorable than credit rate peers. So that could be the potential credit implications of that very specific reform, depending, of course, on the ongoing discussions in the parliament. But I think what is also very interesting here is that the suspension of this very important reform is, I think, one good example to assess the impact of the current political environment on the reform momentum, but also on policy continuity and policy predictability. But yeah, maybe this is something that we can discuss later in this presentation during the political outlook.
Yes, indeed we can. So if we leave the fiscal outlook for the moment and then turn to funding and the flexibility that both the US and France have, Eiko, perhaps you can address this curiosity in the sense that France, or rather the US, looks as if it has is in a weaker situation, higher deficits, higher net interest payments, and higher debt to GDP. But we as a rating agency have a stable outlook for the US, and we have a negative one for France. Can you perhaps square that circle for people on the call?
Yes, of course. So for the US, despite the weak public finance outlook that we have, there are several key strengths that support the rating as well. So these include, first of all, the role of the Federal Reserve, which is still widely regarded as the leading central bank in the world. Second, we have the unique global role of the US Treasuries and their status as a sort of primary safe haven asset. And then finally, also, we have the US dollar as the world's reserve currency. Maybe I take each of these briefly in turn. So first, you already saw in the previous slides that the share of government revenue allocated to interest expenses increased faster in the US than in France, and in fact, also faster than for most other developed economies. And this is largely driven by the relatively short average bond maturity of less than 6 years in the US. That compares with an advanced economy average of around 8.5 years. And that means that higher interest rates are transmitted to the debt dynamics relatively quickly in the US. And it's also one of the reasons why the current US administration has been pushing the Federal Reserve to cut policy rates much faster than we have seen so far. Unsurprisingly, shorter maturity bond yields tend to be more closely aligned with the official policy rate compared with, for example, 10-year bond yields that you see in the chart. However, this political pressure on the Fed has also raised some questions regarding the central bank's independence, and we expect this pressure to remain high also next year, as Jerome Powell's term will end in May 2026. Considering US Treasury holdings, so foreign investors continue to be important buyers of US debt. More than 20% of US debt is held by foreign banks, non-banks, and the official sector. And important to note here is also the large share of US non-bank holdings, which account for around half of US general government debt. And a portion of these will also relate to foreign investors purchasing US treasuries through US-based investment funds. And the global role of US treasuries as a primary safe haven asset is clearly an important factor that will also continue to support high demand for future US debt issuance going forward. And then finally, and related to the previous point, is the role of the US dollar as a global reserve currency. So we expect the US dollar to remain in this role even as the share of official foreign exchange reserves has been on a declining trend. So it reached 58% in 2024. That's down from around 72% in 2000. But still, we expect this long-term trend to continue and perhaps accelerate somewhat, given the volatile seen recently as investors start to diversify their investments away from US assets as well. And so to quickly sum up, particularly the role of the US dollar and US treasuries provide significant funding flexibility and also help to mitigate some of these long-term debt sustainability concerns that would otherwise clearly be more acute for the US. And overall, this also supports then our view of the stable outlook for the current AA- rating level. And then, so clearly France, also just to make the comparison to France, has significant funding flexibility and also benefits from the role of the euro and its position in the European Union. But again, I would hand over to Thomas at this stage just to provide us with a bit more detail.
Thank you, Eko. Indeed, for France on funding flexibility, so the European Central Bank continues strong and effective monetary policy making, currently holding policy rates at 2%. But the risk here we see for France is that higher refinancing rates on the long end of the curve persist in the coming years. So this is what you can see on the first chart. And that's related to a more challenging fiscal and political outlook. So our baseline is that the current funding conditions, the risk premium will remain slightly more challenging in the coming years, especially in case of renewed political instability or in case of a more volatile policy making after the presidential election. And here we also note that France is relatively more exposed to non-resident investors holding more than 50% of the marketable debt. And those international investors could be more sensitive to domestic political developments, especially if those investors are located outside Europe. But that being said, we also expect France to retain excellent market access and high funding flexibility that is well reflected here on the right in the bid to cover ratio and the weighted average rate of bond issuances, which are both solidly anchored on their long-term average. And that is obviously supported by the euro as a reserve currency, very strong debt management, a long average debt maturity above 8 years, and a very solid banking sector for which the government bonds are relatively attractive under current market conditions. So we are not concerned by moderately higher refinancing rates, and we think that the 2026 funding program that is expected to be around 10% of GDP will be executed smoothly, even though higher refinancing rates over time will increase interest payments, as we discussed, and make the reduction of the primary deficit even more important for the fiscal and debt sustainability and overall for the credit profile. So this is how we look at the funding flexibility in France, but maybe, Matthew, we can pause here again for any questions.
Thanks, Thomas. Yeah, if we again go back to the US, Aiko, you mentioned the diversification of investors out of US dollars, and that's been happening for a while. So the question here is there a clear threshold where the dollar can no longer sufficiently support the weakening public finances at the rating level that we at Scope have for the US?
Yeah, so it's important to underline that this diversification out of US dollar holdings is a very gradual process, and US public finances still continue to benefit from really exceptionally deep and liquid capital markets. And as this gradual process continues and public finances continue to weaken at the same time, there can be obviously some further upward pressure on financing costs, but there's no explicit threshold in that sense. Maybe just purely from a sort of rating scorecard perspective, the US rating benefits from a positive 3-notch adjustment because of the US dollar under our sovereign methodology. This is based on shares within the IMF special drawing rights basket. And the next time this basket will be updated is in 2027. But we don't really expect a significant shift here in the near future. So unfortunately, no, I can't give you a clear threshold, but it seems safe to say at least that the US dollar will certainly continue to be supportive for the rating for quite some time.
Good, thank you, Aiko. And if we switch back to France, obviously we know in the US there's a very particular budget standoff with around the debt ceiling. Of course, in France we have a budget standoff of a different sort. Thomas, can you talk us through your view on the implications of these delays in approving the 2026 budget?
Sure. So on the budgetary process, I think first the fiscal framework in France is relatively weaker than in some credit rating peers, and this explains the uneven track record in terms of fiscal consolidation that we saw in the past. And it's well documented that fiscal targets were missed by successive governments and parliaments. But we also recognize that the fiscal framework gives some flexibility to navigate the current political uncertainties. And as this was the case, for example, with the special law that was introduced to get the 2025 budget approved by the parliament in February this year. So I think, we are not very concerned by potential delays in the budgetary process, but what is more important, I think, for the credit profile is that 2 prime ministers voted down by the National Assembly, and the difficulty to pass the budget by end December raise uncertainty on the sustained execution of economic and budgetary reforms over the coming years. And what is also very clear is that in the current political environment, it has an impact on the reform momentum. And again, one good example here is the suspension of the pension reform. But the political fragmentation and polarization that we see have also implications for the annual budget and for the fiscal consolidation over the medium term. So yeah, that's a very important point for France in terms of the political outlook. So maybe also a good transition for you, Matthew, for the next section.
Well, thank you, Thomas. I think that's absolutely right. You sort of, we're already getting into the whole governance question there. So you've mentioned fragmentation, and you mentioned a bit about polarization, but perhaps an equally important issue is instability. Perhaps you want to talk about that aspect of politics in France and how that affects governance and in turn our credit outlook.
Yes, sure. So in terms of politics in France, so there is here also a lot to say, but I'll try to be brief with three main points. One about fragmentation, two about polarization, and three instability. So first, there is high fragmentation across the political spectrum, and this is well reflected in the current parliament, and especially the National Assembly that came out of the 2024 early legislative elections, as you can see on the first chart. The concern here for the credit profile is that political fragmentation already had an impact on the reform momentum, because in 2023, the government was struggling but still able to pass very important reforms. Then in 2024 and 25, there were difficulties to pass the budget, with two center-right governments voted down by the National Assembly. And this year, there were also difficulties to form a stable government coalition. So now the risk is that the fiscal consolidation and reforms are further delayed until the next presidential election, simply because it's more difficult for the government to find a political compromise in the parliament, but also because any government willing to force the budget or reforms through the parliament is likely to be voted down again by the National Assembly. So that means that fragmentation is a concern for the credit profile, given the risk of policy paralysis. Then, looking at the composition of the National Assembly, the polarization has also increased over time, with parties at the extreme of the spectrum holding about 35% to 40% of the seats. And that is also a risk for the credit profile in terms of policy predictability and continuity, especially after the next presidential election, as some political parties could be relatively less committed to fiscal consolidation and to structural reforms. I mean, obviously, we don't want to speculate on the next election, but there is high uncertainty surrounding the economic and public policies that will be pursued over the medium term in France. And finally, the third point on the next slide, in terms of instability, the French institutions are such that the president needs to have a majority in parliament to advance his policy agenda. So the presidential party always had a majority in the National Assembly over the past 25 years, except in the late 90s and since 2022, which led to early legislative elections last year, then political instability, and then some difficulties to form a stable government coalition. So on the second chart, you see that the number of governments has steadily increased over time, from 2 governments in the early 2000s to 9 governments under the current presidential term. So now the institutions in France are still very strong, and our baseline is that this will continue to support the credit profile. But we also consider that the risk of political or even institutional instability has increased due to this highly divided parliament and the upcoming presidential election. So the key risk here for France is to move over 5 years from political uncertainty to political or institutional instability. And this could have obviously negative credit implications by preventing the execution of the fiscal consolidation plan and the introduction of reforms, which are much needed to address the credit challenges. So yeah, that's how we look at the political outlook in France. That will remain a key rating driver, like in the US. So maybe Matthew, let's move on with the political outlook in the US.
Yes, Eiko, I mean, as Thomas has said, there's a slightly concerning governance trend in France, and I think that's been equally an important factor in our outlook for the US, but obviously the circumstances are different. So perhaps you can explain how that weakening governance outlook in the US has influenced our perspective on the sovereign rating.
Yes, correct. So the weakening governance standards and also the lower predictability of US policy making were one of the key drivers in our latest US rating action. The two charts you see here help to illustrate some of the points we raised. So first, the sharp increase in the use of executive orders to implement policy changes rather than making such changes through Congress demonstrates a clear consolidation of power within the executive branch of the government. And in our view, this has come at the expense of the other two pillars of the US checks and balances, being first of all the legislative branch or Congress and the judicial branch. And this was clearly demonstrated in recent months, as shown by the administration defying court orders, challenging judicial authority, circumventing congressional oversight, and also marginalizing several independent agencies. And all of this weakens the institutional safeguards that were put in place to limit executive power. We consider that this reduces also the predictability of US policymaking, which has also been demonstrated quite clearly in tariff negotiations with key trading partners in the past couple of months. The current shutdown is now the longest in US history, with little sign of a quick resolution in the next few days. As you can see in the chart, such shutdowns have become longer and more frequent in recent years. And while from a sovereign rating perspective, this is perhaps less concerning than the regular debt ceiling crises, it is a clear reflection of the deepening political polarization in the US. And then in my final slide on the US, I just wanted to illustrate why this matters. So first of all, the US faces important structural fiscal challenges. In the current environment, we see the likelihood of sufficient bipartisan compromise, which is really needed to address these, as pretty low. And the signing of the One Big Beautiful Bill Act has not helped this and has arguably only further increased this polarization. And we'll have to see how the current government shutdown is ultimately resolved, but there remains a risk that a compromise on healthcare expenditure could mean some further upward pressure on the already high fiscal deficits. Just one more important point to flag regarding the One Big Beautiful Bill Act. So the biggest negative impact on the primary deficit clearly comes from the extension of the 2017 tax cuts, which you can see by the very big bar here. So we expect that this would have happened irrespective of whether Republicans or Democrats were in power, since not doing so would have effectively been a very large tax increase. It's therefore also likely that most of the policies, such as additional tax cuts in this One Big Beautiful Bill, are here to stay and will not expire as currently planned. I already mentioned the risk of recurring debt ceiling crises. And so in principle, the recent signing of the One Big Beautiful Bill Act has reduced this risk, at least in the near term, since the debt ceiling was raised by $5 trillion to 41.1 trillion. However, given the high deficits, we expect this level to be exceeded around 2027, making the results of the November 2026 midterms a key determinant of whether another political standoff will occur. And with this always comes the associated risk of a near or technical default. Such a scenario certainly does not feature in our base case, but the rising polarization does increase the risk that political parties may not be able to reach an agreement in time during a future negotiation. And with that, I would hand back to you, Matthew.
Thanks, Eiko. Look, we've got a question, and I think it's maybe a good opportunity to take it now on the US. There are two questions, in fact, but the first one, let me ask, is the following. How has lower sovereign support for government-sponsored enterprises and the contingent risks of government-sponsored enterprises been assessed in terms of its impact on the rating in the US by Scope?
Sorry, can you repeat the question?
So how has lower sovereign support for government sponsored enterprises and the contingent risks related to that been assessed by Scope in our rating?
I mean, this is considered within our qualitative assessment for the US. So we have our quantitative assessment, which essentially covers the sort of economic fiscal risks, and the contingent liability risks is then very much assessed, for example, when we consider financial imbalances that increase. Yeah, so that would be my quick answer.
And I've put in the chat, you can see it in the chat there, Eiko. There's a question also about our notches in terms relative notches of our rating relative to dollar status. What up notching comes from the various factors in our methodology?
Yes, so you mean in terms of the 3 notches that we assign to the US dollar reserve currency status? Yes. So there is no explicit additional notching for the other 2 factors that I mentioned, being the Federal Reserve and the high demand for US treasuries. But these factors are also incorporated within the rating. So from the Federal Reserve perspective, if a country has stable inflation, this is something that that supports a rating. At the same time, if a country has lower financing costs, that supports our assessment of the public finance risk pillar within our assessment. So these factors are incorporated within the rating, even if they don't have an explicit sort of plus minus plus 2 notching within the methodology.
Okay, thank you for that. And sticking with you, Eiko, a lot of interest in the US. Obviously, this week we're back. We have tariffs in focus again with the US Supreme Court hearing. What has the whole tariff discussion in the US had? What impact has it had on our rating perspective on the US?
Yes, so there is a possibility that some of the tariffs imposed by President Trump could be ruled as illegal. So in particular, those that were imposed under the International Emergency Economic Powers Act, which is a law really designed more for national emergencies. And so while this could cause some disruption and potentially also reduce tariff revenues, I would expect this to be temporary. So several trade deals have obviously already been agreed. And discussions with key trading partners will probably not materially change, given the possible threat that the administration can always raise of even higher tariffs that could be imposed under some alternative executive powers. However, it does tie in with our view of weakening checks and balances in the US, with a clear concentration of power in the executive branch at the expense of the legislative and judicial branches.
Okay, thank you for that. And perhaps, given the time, our final question here. This is on again the issue of policy missteps, which you've mentioned. How does this apply to the Federal Reserve and the debate about the appointment of new governors?
So, I mean, the political pressures on the Fed to lower policy rates has clearly been demonstrated by the administration. The recent reduction in policy rates can be justified because of some weakening in the labor market. Although at least so far, overall economic growth has been more resilient than most observers expected. And at the same time, inflation still runs above target and could face some further upward pressure as tariff-related price rises start to feed through. And it's important to state that the Fed has a dual mandate, obviously. So first of all, price stability, and second, maximum employment. What I could imagine is that there may be somewhat less of a focus on the first of these 2 going forward. So with a stronger focus on maximum employment and less of a focus on price stability going forward, given the political pressure.
Well, Eiko, thank you very much, and thank you to Thomas. I think we've had an excellent survey there of both the US and France. Thank you to everyone who joined the call today. It's been a pleasure to have you with us. We will send out the slides as promised to those of you registered, and the webcast itself will be available on replay. Look out on LinkedIn for our feeds, and we'll send you a link for that as well. So thank you, everyone, and enjoy the rest of your afternoon.